Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready for another rigorous examination of one of the foundational businesses that truly underpins the entire global financial system.
We are absolutely stepping away from the speculative meme stocks today. We are going deep, really deep into the bedrock.
The bedrock, I like that.
Yeah, the indispensable infrastructure that allows, multi-trillion-dollar investment decisions to be made with confidence every single trading day.
Exactly. Today, we're breaking down one of the most durable, high-quality, yet, well, sometimes overlooked powerhouses in financial services. FactSet Research Systems, ticker FDS. This is the company that provides the integrated financial information, the world-class analytics, and those highly curated data feeds to the buy side, the sell side, the entire global wealth management community.
And FactSet for decades has really represented the investment ideal. It's the ultimate recurring revenue engine.
Right.
A truly durable business with just extremely high profitability and impeccable cash conversion. It's really the definition of a financial fortress.
But that leads us to the central, crucial question, and really the entire mission of this deep dive.
Okay.
Can a business model that built its fortune on proprietary data systems, which is now decades old, survive what feels like an existential threat from generative AI? And, of course, the relentless, deep-pocketed competition from titans like Bloomberg and S&P Global.
That's the whole game right there.
We have to determine if their moat is merely technical, something that can be leapfrogged, or if the high switching costs created by their proprietary integrated data truly make this a compounder worth paying a premium for over the next decade.
That's a massive question. One that really defines the margin of safety here. And before we get into all the details, just a quick note for everyone watching.
For those of you who want to act on these investing ideas, having a professional-grade platform is what's key. We use Interactive Brokers, and we've actually partnered with them to get you, the listener, a stock bonus when you sign up.
So you get a bonus that helps start your portfolio, and you support the channel at the same time. That link is in the description, right?
That's absolutely correct.
Yeah.
And, of course, if you find value in this kind of in-depth discussion, the single best way to let us know and to make sure you get the next one is to subscribe and like the video. It truly helps the channel.
It really does.
And if you have any questions at all regarding FactSet or just the financial data space in general, please manifest yourself in the comment section.
Wonderful. Now let's dive into the core analysis. Pillar number 1, the Tollbridge model and the switching cost moat.
Okay, let's unpack the core model. When we look at FactSet, we're looking at something investors absolutely cherish: business model intelligibility. It is just so simple and straightforward how they generate cash.
It is.
And that simplicity, it often signals tremendous durability.
It really does. The overwhelming majority, we are talking 90% plus of their revenue streams from subscription-based annual subscription value, or ASV.
So they're not selling hardware.
No, not selling hardware or one-time consulting projects. They are selling access. Pure and simple, access to the integrated FactSet workstation, access to the analytical applications, and increasingly access to raw, clean data feeds via API.
And the beauty of this model for the business itself is that clients pay this recurring fee, right? Usually contracted on an annual or even multi-year basis.
That's the key.
This means FactSet has just outstanding revenue visibility and predictability. They aren't worried about macroeconomic swings month to month.
Not at all. Their profits are not driven by trying to land thousands of new speculative clients every year. It's all about maintaining incredibly high retention rates. We're talking high 90s for ASV, and then just leveraging modest incremental price increases on that sticky base year after year after year.
And what's truly fascinating here is the structural endurance this business possesses. This isn't some novelty app. It's mission critical. It's essential infrastructure for the global financial machine.
It is. Think about the underlying trends that reinforce its endurance. The volume and the sheer complexity of global financial data are growing exponentially, which demands better tools to ingest and analyze it all.
Right. And then you have the regulators.
Exactly. Regulatory compliance now requires more traceable, auditable, and verifiable analysis than ever before. And fundamentally, every investment professional, from the largest sovereign wealth fund down to a mid-sized private equity shop, needs superior tools for a competitive edge.
That reliance on the core human impulse for seeking information, for analysis, for efficiency, it's evergreen. It's not going away. It's a fundamental, non-discretionary part of the capital market structure.
You're spot on. You simply cannot operate a modern financial institution without a tool like FactSet or a Bloomberg or CapIQ. It's table stakes.
Which is the perfect segue to defining their economic moat. When we analyze this space, the primary moat isn't just about the quantity of data. A lot of companies have vast amounts of raw data.
Right, data itself is becoming a commodity. FactSet's advantage is the high switching costs, reinforced powerfully by intangible assets. Specifically, they're proprietary, integrated, and this is the key word, meticulously cleaned data sets and unique symbology.
Okay, let's get granular on that. What does meticulously cleaned actually mean in practice? It kind of sounds like marketing speak, but you're saying it's the core of the moat.
Oh, it's not just marketing. It's the difference between structured data and unstructured chaos. FactSet takes all this disparate financial data company reports, fundamental metrics, economic releases, analyst estimates, and it applies a proprietary layer of normalization and unique identifiers.
Give me an example.
Sure. If you were comparing Company X's historical debt levels across, say, 30 different filing periods, those numbers often need subtle adjustments because of reporting changes or acquisitions or restatements. FactSet cleans all that, they backfill it, and they tag that data with a consistent proprietary FactSet identifier or symbology that links everything together seamlessly.
I see. So the switching cost isn't just about the software interface you get used to.
Yeah.
It's about the underlying architecture of the data itself.
Exactly.
If a client switches, all their models that were built using FactSet's unique identifiers and that clean historical data structure, they just break instantly.
Precisely. And that brings us to what I call the friction penalty. This is where the moat actually defends its fortress walls. For a major asset manager, the FactSet workstation and its famous, ubiquitous Excel plugins, they become the operating system for their entire proprietary research process.
The OS, okay.
Yeah, their customized discounted cash flow models, their portfolio analytics, their whole research management system. It is all coded using FactSet's language and its data structure.
So if they decide to switch to, let's say, Capital IQ, just to save a theoretical 10% on the annual subscription, they're facing an existential operational risk.
A mass one.
They don't just cancel a license. They have to undertake a massive, probably multi-million-dollar project to migrate potentially years of custom models, reprogram their proprietary valuation systems, and, crucially, retrain hundreds of highly paid staff who rely on specific shortcuts and formulas they've used for a decade.
And the human element there is so critical. Analyst workflow efficiency is paramount. If you risk even a 5% drop in productivity across a 300-person research team for 6 months during a transition,
The cost of that is astronomical.
the cost and the risk of that operational disruption far, far outweigh any modest subscription savings. The platform is truly deeply embedded.
This business, then, it perfectly embodies that Tollbridge or mandatory pass and mental model.
That's it.
They own an essential piece of infrastructure, and their recurring high-margin revenue is just a function of that mandatory passage. It's like owning the only railroad tracks into a major city. You simply have to pay the fee to use them.
And we assess the moat trajectory here as stable to widening. This isn't a static business just resting on its laurels.
So how is it widening?
The widening is directly driven by FactSet expanding into more workflow tools and deepening that data connectivity.
Can you elaborate on those efforts?
Yeah, take the open FactSet marketplace, for instance. By allowing third-party data providers and even proprietary client data to easily plug into the FactSet ecosystem, they make the platform exponentially stickier.
So you bring your own data in, and now you're even more locked in.
Exactly. Every new integration, every custom dashboard, every API connection that a client builds using FactSet's underlying data structure is just another layer of that friction penalty. They're increasing the switching cost with every single successful deployment.
That said, let's run the Scuttlebutt view. What do the users actually say? Because at the end of the day, if the product is terrible, even the highest moat can be jumped.
It's a fascinating duality, actually. The products are generally loved for their comprehensiveness, especially for detailed fundamental and equity research, but they're often tolerated for their price point or the sheer complexity of the feature set.
So love-hate.
Sort of. They get praised for the depth of their historical data, the clean interface compared to some rivals, and this is a big one, consistently excellent customer support.
It sounds like FDS is the highly reliable, maybe slightly over-engineered German sedan of financial software.
That's a perfect analogy.
Everyone complains about the maintenance cost, but it never ever breaks down when you need it for a critical task.
That's it. And the complexity, funnily enough, is actually a feature, not a bug in terms of the moat. It takes a significant time investment to master the comprehensive feature set, making senior staff very reluctant to switch platforms late in their career.
Which brings us to the competitive landscape. You just cannot discuss FBS without discussing the Goliaths they face every single day.
Absolutely. First, you have the 800-pound gorilla, the Bloomberg terminal.
Of course.
Their core strategy is total, all-encompassing dominance. They leverage real-time market data, order execution, trading functions, and most powerfully, that proprietary communication network, the chat function, which is itself an enormous switching cost. Bloomberg is built for the real-time trader and the front office.
Okay, then you have S&P Global Market Intelligence, or Capital IQ.
Right, and their strategy is fundamentally different. They leverage the parent company's massive intangible assets, the essential credit ratings, the global indices like the S&P 500, and they integrate a comprehensive financial data platform on top of that. They come with enormous institutional clout.
So where does FactSet fit in? How do they survive, let alone thrive?
FactSet retains its durable advantage by positioning itself as the superior solution for deep financial modeling and data integration.
So it's a specialist.
Exactly. Bloomberg is great for quotes and news. FactSet is great for building complex valuation models that rely on 20 years of cleaned, back-adjusted data. They are built for the researcher and the portfolio manager performing detailed due diligence.
And critically, FactSet often functions as a high-quality alternative that comes in at a lower total cost than a full-fat Bloomberg terminal subscription, right?
That's a huge selling point. It makes it the preferred choice for investment research teams that need that deep analytical depth, but without all the trading desk overhead.
I see.
Moreover, they've invested so heavily in their APIs and Excel plugins, maintaining a clear advantage in that specialized investment research workflow. And they just have a reputation for genuinely better customer support compared to S&P's platform. They don't try to be a trading system. They aim to be the definitive analytical workbench.
So they've mastered the art of dominating the niche within the giant's shadow. And that focus is why they can maintain those incredible margins.
That's the key to the whole model.
Let's shift from the product's defense mechanisms to the financial plumbing, the economics, and the people running the operation. We need to determine if the business quality extends beyond just sticky contracts. And we have to start with the financial quality ratios.
Right. When we talk about a wide moat, we need to see financial evidence that just screams high quality. And FactSet's financials, they deliver.
Right.
Profitability is remarkably high and consistent. We're talking gross margins consistently in the mid-60% range and operating margins often hovering around 30% or even better.
And those are the hallmark ratios, aren't they?
They are the absolute hallmark ratios of a subscription-based data business that possesses durable pricing power and very low marginal costs.
But the ratio that I think truly determines capital allocation excellence is the return on invested capital, or ROIC.
Yes. FactSet consistently generates an ROIC in the range of, say, 16% to 20% or more, depending on how you define capital and the specific cyclicality of the year.
Okay, explain why an investor should focus so intensely on that specific metric. Why is 16% so meaningful?
Because it tells you how efficiently the company is using every single dollar of shareholder capital and retained earnings. A high, stable ROIC like this demonstrates superior capital efficiency.
Go on.
Think about it. Once they have the data infrastructure built and the software developed, the cost of serving the next 1,000 subscribers is near zero. They require relatively little new, heavy capital expenditure to generate increasingly high returns on that existing asset base.
So competitors can't just throw money at the problem.
They can't. Their durable competitive advantage simply cannot be eroded by competitors throwing vast amounts of money at it because the infrastructure is already paid for. They are just compounding capital exceptionally well, year after year.
Now, let's discuss the truly fascinating aspect of their financial profile, free cash flow conversion. FactSet's FCF conversion rate is legendary. It often runs at greater than 100% of reported net income.
It does.
Now, that sounds like financial magic to the uninitiated. Let's break down exactly why this phenomenon occurs, as it speaks directly to the quality of the earnings.
It's not magic. It's really just the power of their billing structure interacting with accounting rules. When FactSet signs a client to an annual subscription, the client typically pays that entire subscription fee, say $20,000 upfront at the beginning of the contract year.
Okay, so the cash is in the bank on day one.
The cash is in the bank. Under cash accounting, FactSet has that cash immediately. But under accrual accounting, they can only recognize that $20,000 worth of revenue over the course of the full year.
So on day one, they receive the full cash payment, but they only recognize 1 day's worth of revenue on the income statement. Is that right?
That's exactly right. The difference between the cash they received and the revenue they recognized is booked as deferred revenue, which is a liability on the balance sheet.
Yeah.
As the year progresses, that deferred revenue gradually converts into recognized revenue. But the key is that this strong, consistent inflow of upfront cash creates a massive working capital tailwind. This operating cash flow, before deducting any needed CapEx, consistently exceeds the reported net income. It is the purest definition of high-quality earnings backed by tangible cash flow.
And finally, the balance sheet strength. Given that robust FCF generation and the rock-solid predictability of that recurring revenue stream, they can afford some debt.
A reasonable and prudent amount, yes. We see their net debt to EBITDA generally sitting in the range of about 1.5x to 2.5x.
Which is very comfortable.
It's a very comfortable and modest level of leverage for a company with this degree of cash flow reliability. It signifies a strong financial fortress, providing management with ample flexibility for accretive M&A or shareholder returns via buybacks, without ever risking the firm's stability during an economic downturn.
Okay, now let's talk leadership. Who is steering this incredibly strong ship? We recently saw a key CEO transition from Phil Snow to Sanoki's Wanathan. Did this signal a shift in strategy, or was it about continuity?
I think the transition appears strategically sound and really emphasizes continuity, but with a modern twist. Snow delivered incredible shareholder value, focusing on client-centric growth and disciplined execution.
And the new CEO?
Viswanathan, who has a strong financial services and technology background, particularly from his time at JP Morgan, brings a very clear innovation-first mindset.
And how does that mindset translate into strategy for us as investors?
It means a sharp focus on expanding the value proposition and modernizing the workflow and data solutions, specifically leveraging cloud technologies and, most critically, generative AI.
So he's not running from the threat.
He's running towards it. This signals a management team focused on defending the moat for the next decade, not just managing quarterly expectations.
We also look at management incentives and ownership. I know insider ownership is relatively low, which is pretty common for massive, established, institutional-focused companies.
It is.
But it's important that their compensation is aligned with the long-term health of the business.
And it is. Their compensation is tied directly to metrics that matter for a subscription business: annual recurring revenue growth, customer retention rates, and maintaining those strong operating margins. That discourages speculative short-term behavior and reinforces the focus on long-term compounding.
Okay, so let's apply the rationality test. How do they deploy that abundant free cash flow? Because a great business can be destroyed by poor capital allocation.
They are exceedingly disciplined. Their hierarchy of capital deployment is simple. First, they prioritize reinvestment in the Moat R&D, aiming to defend and expand the technological edge organically. FactSet has historically spent a massive portion of its revenue back into innovation.
And then M&A. They haven't been afraid of making deals, but they're not these blockbuster deals like some of their competitors.
Precisely. They use highly strategic, targeted acquisitions. Look at examples like Irwin, which enhances their corporate client workflow, or Liquidity Book, which strengthen their presence in portfolio, order, and execution management solutions for the buy side.
So they're filling gaps.
They're filling gaps. These aren't speculative. They are bolt-on acquisitions used specifically to fill workflow gaps or integrate specific data capabilities, making the entire platform stickier and more valuable.
And the residue of that discipline, after all that organic reinvestment and accretive M&A, is returned to shareholders.
It is, through a tremendous history of annual dividend increases and highly effective share buybacks, which are perfectly rational given their superior ROIC.
So in essence, the management team acts as a truly rational capital allocator.
They do. They understand that their high ROIC justifies using excess cash for buybacks, while the predictability of the FCF supports a reliably growing dividend. They are a compounder that caters to both growth and income investors simultaneously.
We've established that FactSet is a demonstrably high-quality business. But here is the inevitable hurdle. Quality almost always comes with a premium price tag. Let's tackle the valuation reality check head-on.
Right. Historically, FactSet has rightfully commanded a premium valuation. You expect high PE and PFCF multiples because the market pays up for predictable recurring revenue, that superior profitability, and its status as essential infrastructure.
But we have seen some recent stock price pressure, however, which has led to a moderate discount relative to its historical multiples. The current narrative suggests that the price may be underestimating its intrinsic value. But we must never forget the fundamental price hurdle.
This is the core tenet of long-term investing, isn't it? A truly great company bought at too high a price is simply a poor investment.
Exactly.
Because FactSet is so high quality and so predictable, it rarely, if ever, trades at a price that screams cheap.
Let's put some illustrative numbers to this. If the market average PE is, say, 18x, and FactSet has historically traded at 35x PE during peak sentiment, you might be buying a stock where the price already bakes in 15 or even 20% perpetual growth into the valuation. If the company executes perfectly, but only achieves 10% sustainable growth, you'll likely earn mediocre returns.
Because the quality was already fully discounted at your entry point.
Exactly. The true margin of safety, therefore, is obtained when the price assumes minimal future growth low to mid-single digits for an extended period.
Right. If you can acquire a business with a 16% ROIC at a valuation that implies 5% perpetual growth, well, the downside is contained, and any execution success beyond that 5% becomes pure upside.
So we need to define what creates that temporary opportunity for a margin of safety. What causes the price to temporarily depress without breaking the underlying model?
The first, and probably the most common, is a severe temporary industry contraction. Picture a major global recession forcing severe budget cuts across the financial sector, leading to material headcount reductions and, consequently, seat cancellations for FactSet users.
So a big macro headwind.
A big macro headwind. This would create a temporary but significant drag on annual subscription value growth. This noise depresses the stock price, but doesn't damage the product's underlying competitive advantage or the moat structure.
And the second scenario?
A company-specific glitch. This could be a poorly communicated CEO transition, a failed or slow integration of a recent smaller acquisition, or maybe a temporary technological stumble that causes a short-term earnings miss and perhaps an analyst downgrade.
Fixable problems.
Fixable operational hiccups, exactly. And they offer that classic Buffett opportunity to acquire a wonderful business at a decent price simply because the market has overreacted to cyclical or temporary noise.
So in either scenario, we're not looking for signs that the moat is permanently broken. We're looking for transient periods of fear or overreaction that allow us to buy quality assets for less than they are truly worth.
That's a discipline.
Now, assuming we get the right price, where does FactSet's incremental revenue growth actually come from to justify long-term ownership? Where is the engine driving future growth?
The primary growth engine is the expansion of their total addressable market, their TAM, outside of the traditional front office buy-side user base. Historically, they've dominated the equity research analyst and portfolio manager demographic.
But those markets are mature, aren't they? To achieve sustainable double-digit growth, they have to move laterally.
Absolutely. They are focused aggressively on new territories: wealth management, corporate users, and the middle and back office.
Let's talk about wealth management.
The wealth management market is massive, and it's undergoing a digital transformation. FactSet is positioning its integrated workflow solutions and robust data APIs to capture significant market share there, which is often dominated by disparate, less sophisticated legacy systems.
Can you provide some context on the size of these opportunities? How big is the corporate market, for example?
The corporate market think treasury and internal strategy departments at major non-financial companies. They need access to clean, real-time data for competitive analysis and M&A screening. This TAM is significantly larger than their traditional focus. By successfully embedding their APIs and workflow tools into these new areas, they diversify their revenue base and unlock a new multi-billion-dollar runway for sustained growth.
Okay, so a lot of runway there. Finally, what are the near-term catalysts that could re-rate the stock higher and break it out of the current valuation correction?
I'd say number one is proving the technological transition, successful GenAI monetization.
What does that look like?
We need clear, productized evidence that FactSet is effectively integrating its new AI tools, such as the conversational APIs or their generative pitch creator feature, into new differentiated pricing tiers, or using them to justify higher average selling prices per user.
So if they can demonstrate that their AI tools powered by their proprietary clean data significantly increase the productivity of an analyst and justify, say, a 15% increase in subscription price,
then the market will instantly recognize that technology is a powerful tailwind, not a fundamental risk.
And the second catalyst:
securing buy-side workflow dominance in new markets. If FactSet announces major, sticky wins in the high-growth wealth management sector or successfully unseats incumbents in the corporate market, It validates the whole TAM expansion strategy and demonstrates that the platform can succeed outside its historical sweet spot.
Okay, we've established that FactSet is a wonderful business, but we must now apply the red team challenge. No business, regardless of its quality, is immune to permanent impairment. What are the major structural risks that could permanently damage this financial fortress?
The single biggest risk, and it really overshadows all the cyclical and competitive threats, is technological disruption by AI and large language models, or LLMs.
The nightmare scenario.
It is. The true nightmare scenario is not an incremental improvement from a competitor. It's a new entrant, maybe a major tech giant like Google, or a well-funded, focused startup developing an open-source LLM, or a specialized financial LLM that can ingest, synthesize, and analyze unstructured financial data with equal or greater efficacy than FactSet's current proprietary tools.
And if that happened, if the task of converting mountains of PDFs and regulatory filings into usable analytical insight becomes a free commodity AI service,
it fundamentally shatters the intangible asset moat. The specialized financial analysis that FDS charges a premium for becomes ubiquitous, and that high switching cost friction penalty diminishes drastically.
Okay, what's the second critical risk?
Aggressive competition from the titans, leading to a pricing war. Imagine if Bloomberg or S&P decided to dramatically undercut FactSet on price in the research segment. Or what if they leveraged their other business segments' trading commissions for Bloomberg, ratings fees for S&P to create subsidized, comprehensive product bundles that forced mass client migration?
Such a move would be brutal because it would directly attack FactSet's key metric, its incredibly high ASV retention rate.
Right. If retention dropped from 95% to, say, 85% for a sustained period, the compounding engine would just seize up.
And while less permanent, we do have to acknowledge the inherent cyclical risk.
Of course.
Right.
The financial sector is inherently cyclical. A prolonged global recession that forces major financial institutions to conduct massive, sustained layoffs would lead to material client attrition and deep, non-discretionary budget cuts. It would immediately hurt that predictable ASV base.
Let's lean into the red team challenge and really invert the bull case. We have to assume the moat is an illusion for a moment. Walk us through the failure scenario. What does the low-margin commodity data provider fate look like?
The failure scenario is an open-source data revolution focused on finance. It really requires two components to align. First, a consortium, or maybe a regulatory body, forces greater standardization and open sourcing of core financial data ontologies, making the fundamental structured financial data that FactSet cleans virtually free.
And the second component.
A large tech player combines that free standardized data with a high-fidelity AI-powered conversational analyst.
And if that core clean financial data and the necessary analytical tools become nearly free and ubiquitously available, then FactSet's software layer becomes irrelevant.
Completely irrelevant. The company transforms from a high-margin Tollbridge, where they dictate the price, into a low-margin commodity data provider competing purely on software interface and customer service.
The switching cost disappears because the competitor offers a superior conversational product powered by open-source data standards. The company's value collapses from a high ROIC software and data firm to a utility business with limited pricing power.
It's a catastrophic outcome.
You say FDS will be a monetizer of AI, but why shouldn't we fear that a large tech firm like Google or Amazon, with infinitely superior LLM training data, compute power, and deep integration into cloud infrastructure, could simply offer a superior conversational tool regardless of FDS's cleaned data? Couldn't they just build a superior analytical engine from scratch?
That is the critical challenge, but here's the counter-argument. Financial data is fundamentally different from general web data. It has to be auditable, verifiable, and connected to specific proprietary identification codes that clients rely on for regulatory purposes.
So trust is a factor.
Trust and specificity. Google doesn't have the deep, decades-long client relationships or the highly specialized, clean, historical data sets needed for proprietary equity research. FactSet's moat is its trust and its specificity.
So the bullish synthesis is that the market is underestimating the extreme durability of the switching cost and the sheer quality of the free cash flow conversion.
I think
The market is over-discounting the technological risk from AI because they're focusing on the software interface risk, while ignoring that FactSet's proprietary, cleaned, and connected financial data is the true, non-replicable moat.
precisely. FactSet is highly likely to be an early and effective monetizer of AI. They have the clean data, they have the distribution channel, and they have the existing trust necessary to leverage AI to justify higher prices and widen their moat against external threats, rather than becoming a casualty of them.
We've covered the 4 pillars of FactSet research systems, from its incredible moat to the existential threats it faces. Let's quickly summarize the investment thesis.
On the bull case side, the reasons to own FDS, we have to start with the durable moat. Extremely high switching costs due to that deep workflow integration, ensuring those best-in-class ASV retention rates.
Next, the wonderful economics. Consistently high ROIC and near-perfect free cash flow conversion, which makes FDS a classic high-quality capital compounder that generates immediate, abundant cash.
And finally, disciplined management. A proven track record of rational capital allocation, prioritizing reinvestment in the moat first, followed by accretive, strategic M&A that strengthens their position in new markets.
And on the bear case side, the counter-thesis, we must acknowledge the primary risks. That technological threat of an open-source, commoditized data revolution, aggressive pricing and bundling from behemoths like Bloomberg, and the unavoidable reality of the high price floor for such a high-quality asset.
Right.
It requires absolute patience in seeking an entry point.
The stock rarely offers that obvious, comfortable margin of safety that many value investors crave. The focus has to be on cyclical or idiosyncratic noise to create a window, not on waiting for a fundamental flaw.
But let's leave you with one final, provocative thought, building on our analysis of FactSet's proprietary data moat versus the threat of the software layer being commoditized.
Okay. We identified that the biggest, most permanent threat is AI shattering the intangible asset. If the core foundational datasets that FactSet uses are truly proprietary and essential, does the ultimate existential threat come from a completely new data collection methodology that FDS cannot replicate?
Like a revolutionary new source of financial truth, such as satellite data or sentiment analysis.
Exactly. Or does the threat simply come from a competitor who figures out how to deliver the existing structured data for free, thereby destroying the value of FDS's infrastructure?
That's a great distinction. If the data source itself is unique, the fortress holds. If only the cleaning and the delivery mechanism is unique, the fortress is far more vulnerable to technological erosion.
That distinction, the difference between a threat to the source of truth versus a threat to the delivery of that truth, is what defines the true margin of safety against future AI disruption. It's the question that will determine if FactSet remains an indispensable fortress or just a slightly old-fashioned toll booth in a rapidly modernizing financial world.
A truly fascinating distinction to contemplate. Thank you for joining us for this deep dive.
We'll see you next time on The Deep Dive.